Take a moment, look at the disclaimer. This content for educational, informational, and entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to spread the word of how BTA analyze the market, how we look at the market. This is Rod from BTA, and we are known as the middle traders. This is part 3 of walking with the market. You see this Saturday morning routine? I'm giving it to you right here. This is part 3 of walking with the market. I look at this every weekend because I want to be ready for the upcoming week. I want to make sure that I stay in tune and stay in step with the market because I'm not trying to lose a lot of money. Making money gonna take care of itself. But trying not to lose my money is the important part. And the other way to do that is to stay in step with the market. That gives me the highest probability, the biggest chance of winning. Because I know 75% of all stocks follow the major market indexes. So I study these things and write the levels down, make little notes, watch it all week. Okay, this is part 3. It's going to be quick. We're just looking at the percentage of stocks above key moving averages. Okay, so let's start with the total U.S. market. The percentage of stocks above its 50-day moving average for the total U.S. market. The 50-day, y'all. If you ain't got a lot of stuff above the 50-day, you ain't really saying much. Remember, the red line on this chart is 40%. When you start getting below 40%, you better pump the brakes. Be careful. Watch yourself. It's a red light. That could be the start of a correction or maybe a complete collapse, downturn. I don't know. But I know when you start getting less than 40% of the total U.S. market above its 50-day moving average, you're looking for a problem. It might turn into a problem, as my mentor would say. You got a problem, Sherrod. Well, right now, only 25% of the total U.S. market is above its 50-day moving average. That's not a lot. If you're not above the 50-day moving average, there's not a lot of momentum to the upside. That's for sure. Okay? Only 25% of the total U.S. market is above its 50-day moving average. Now, I'm going to draw in a trend line here, and I'll redraw it later and save it for everybody. But you see this? Okay? There it is. We ain't getting back above that. You know you ain't nowhere near 40%. Okay? Right now, 25%. Total U.S. market above its 50-day. Let's see what percentage stocks above its 200-day. Only 14% of the total U.S. market is above its 200-day moving average. Okay? Only 14%. We are down near extreme lows. Keep telling you that. You see, we haven't hit these lows. Down in here is where you're down in bear market territory for sure. See, last time we got this low, March 2020, we don't hit it that often, okay? So you're at extreme levels right now. Percentage of stocks above its 200-day moving average is only 14%. And you see that breadth has been moving sideways? Look at how the breadth been moving sideways, okay? There's not a lot of traction. You see, it's sideways consolidation. There's not a lot going on. It's not a whole lot of stocks that's breaking out and trying to get above its 200-day and 50-day moving average for the total U.S. market. So, there's no need to fear, to have FOMO, fear of missing out, because if this rally is going to take off and it's going to get some teeth and it's going to really rally, get some legs underneath it, and run, well, we still got a whole lot of stocks that need to get above its 200-day moving average. And what Paul Tudor Jones say about the 200-day moving average? If a stock is above its 200-day moving average, I'm long and not short. If a stock is below its 200-day moving average, I'm short and not long, or I'm just going to sit on the sidelines. 200-day moving average is the line in the sand, y'all. All right, this is the Standard & Poor's 500. Percentage of stocks above its 50-day moving average, only 23%. Only 23% of the Standard & Poor's 500 is above its 50-day moving average, well below 40. 40 is the red light, stop light, red light, be careful. Pump your brakes when you're below 40. It's not a lot of participation, not a whole lot of stocks are moving. What percentage of the Standard & Poor's is above its 200-day moving average? Only 23%. Only 23% of the Standard & Poor's is above its 200-day moving average. Only 23%. 500 stocks in the Standard & Poor's, y'all. Little over 100 is above its 200-day moving average. And a lot of those are energy stocks and oil stocks. Come on, be for real. If the market is going to run, you got a lot of time. There's no need to fear. No need to have FOMO. No need to be fear of missing out. Because if it's going to run, it got a lot of stocks that got to go. This is not financial advice. But wouldn't it be wonderful if it was? Wouldn't it be great if it was? But it's not. Okay? But wouldn't it be great if it was? This is the NASDAQ composite. The percentage of stocks that's above is 50-day moving average of the NASDAQ. 30%. Only 30% of stocks is above its 50-day moving average in the NASDAQ. It's over 3,000 stocks in the NASDAQ. Come on. Come on, man. Stop the nonsense. They should be ashamed of themselves with all these headlines all over the news and trying to get people all worked up emotionally so they could take your money. Keep telling you Wall Street job is to rob you of your money so they could buy their Lamborghinis and boats. Be careful. Men lie, women lie. Numbers in the charts don't. Only 23% of the NASDAQ is above the 50-day moving average. Point blank and period. Let's go to the percentage of stocks above its 200-day moving average with the NASDAQ. Above its 200-day moving average for the NASDAQ, 13%, 0.9. So you want 14, I give you 14. Fine. 14%. Still, what's that? Nothing. Bear market territory. Watch yourself. I showed you all them levels, showed you them fib levels, showed you the moving average levels, showed you the daily fib, the weekly fibs, showed you the structural, showed you the ETFs and yesterday, in the day analysis for Friday. Don't get your head handed to you. Be careful. Don't give away your hard-earned money. Please don't. Don't get your head handed to you. Only 13%, we'll just say 14% of the NASDAQ is above a 50-day moving average. Be careful. For the Standard & Poor's 500, this is the percentage of stocks making new 52-week highs and new 52-week lows. At the end of the day, this crayon line represents 5%. These crayon lines, horizontal crayon lines, represent 5%. Up here, if the number starts hitting 52-week highs, down here, the number starts hitting 52-week lows. For the Standard & Poor's 500. That's what this daily chart is. And what did you see on Friday? What do you see on Friday? You still got more stocks, more than 5%. It's still trying to find hitting 52-week lows. This is the 5% level for the Standard & Poor's 500. It's only 500 stocks in the Standard & Poor's 500, right? 10% is 50. 5% is 25. We're still hitting over 5%, hitting 52-week lows. It's nowhere in here do you see recently more than 5% hitting 52-week highs. We're well away from highs. That's fine. But the number of stocks still hitting 52-week lows are still happening. That's telling you that the selling is still there. Are you picking up the jewels that I'm dropping? Be careful. Be careful. Here's the NASDAQ. Look at the number of stocks still hitting 52-week lows. This is the same chart. Do you see it? The number of stocks in this is the crayon line. It represents 5%. You don't even see the crayon line for the stock hitting new 52-week highs for the NASDAQ. It's way up here. You can't see it. It's off the charts. It's off the charts. Okay? Okay? So ain't nothing banging right now. It's only busting. You get it? Nothing banging. Ain't nothing banging out here. Okay? Here is the number of stocks hitting 52-week lows. And as you can see, still well over 5% coming Friday. We still selling off. Stocks is still hitting 52-week lows after all this collapse we done had. Watch yourself. Watch yourself. 52-week highs is well over 5%. No reason to fear missing out, because when this thing starts to bang, you're going to see this number getting lower than 5%, and the number of 52-week highs is going to be well over 5%, like it was back here. We can start seeing better improvement when the markets start rallying. But this is short-lived also, because I was right in the middle of a bear market. Okay? But when the bull market comes, you're going to see this thing going to be banging. Okay? It's going to be banging. Now, let's look at our go-to chart, the advanced decline differential invisible chart. Well, we're going to make this quick. The green line is above the yellow and the red, and the green line is above the zero line. The problem here is the red line is pointing down and the yellow line is below the red line. The 21-day moving average of the differential is below the 50-day, which is the red line, and both of them are below zero, and both of them are down. I wrote a note here, told you a long time ago. The best signals when the 21-day and the 50-day is trending up. The yellow and the red is trending up when this green line is above zero. Now, it's very interesting that this green line is holding up the way it is, above zero. That is very interesting. That's something to make me say, Okay, we got the green arrow last week when we got our follow-through day. But the follow-through day looks like it's going to fail. It has a 90% chance of failing. 70, 80, 90% chance of failing, whatever you want to call it. The most recent data says a 90% chance of failing now when looking at this bear market. The previous data, going back over 30, 40, 50 years, 70, 80% chance of failing when you get undercut the low of the first of the follow-through day. So 70, 80, 90%, whatever you want to call it. But at the end of the day, it's a very high chance that this thing going to fall and fail. Point blank and period. So we got our green line that's back above zero. It's above the yellow and the red. But the red and the yellow is pointing down and it's below zero. But it's very interesting that that green line is still above zero. I find that interesting. That's making me say, And for the Standard & Poor's, it looks like it's trying to push higher. This is strange to me. Is this thing gonna try to rally? I don't know, but this doesn't look right. Okay, but we have to see. We got to follow the numbers. But it's just interesting that this green line is holding up above zero. But the red and the yellow is below zero, and the red is still pointing down. The 21-day moving average of the differential, the yellow line, is turning up. Let's see if it crosses above the red and the red turn up. But the fact that this green line is holding above zero is making me wonder if they're going to try to go on a rally. Well, we know our levels on our daily and weekly charts. We know our levels with our key moving averages. We're going to be watching it all. Is this just a lag in the differential chart and it hasn't rolled over yet? Or if it's under the hood, because this is the 9-day moving average of the differential, it hasn't had a chance to catch up yet? I don't know. We're smoothing out the data with these moving averages. But I will say we don't have to worry about it. We just monitor it and watch that green line. But we know it's not a go because the red line is pointing straight down the 50-day moving average and the yellow line is not above the red. And both of them are below zero, pointing straight down. We already got the note. The best signals is when the 21-day and the 50-day is turning up. Okay. The 21 day is below the 50 day. The yellow is below the red. Not good. So now, if you look at the NASDAQ, the advanced decline differential, invisible chart, our chart, ain't going to see it nowhere else on the internet because we created it, just like Lois. You see the swing signals Lois is giving you on the blog every day. I'm putting it up. I'm looking to start working it in where I can start showing y'all on the channel, on the YouTube channel about the swing signals. It's coming soon. But you see it every morning. You can't miss it. Lois keeping you on the right side of the trade, right side of the market. We can't lose with the stuff Lois used. But our invention here, the advanced decline differential invisible chart, smoothed out with these moving averages. Well, the green line's above the red and the yellow is above zero for the NASDAQ. This is the NASDAQ daily chart of it. But its trend is pointing back down. Is it going to get back below zero? The yellow and the red is below zero. We had our green arrow giving us the go to start buying, but the follow-through day is under pressure. We got our green arrow, and then we had the follow-through day. Follow-through day is under pressure, though, y'all. Well, we know it's not a go right now because the yellow and the red moving average is below the red zero line, and the green line is pointing down. Be careful, okay? Be careful. So I told you this wasn't going to be long, all right? We just saw the percentage of stocks above its 200-day moving average. You see the stock still hitting 52-week lows, more than 5%. The selling is still there. And now you see the advanced decline differential chart is telling you to be cautious. The red line is flat and pointing down for the Dow Jones and the Standard & Poor's. The yellow is below the red. The green is still above zero, but the red and the yellow is still down and not trending up yet. And they well below zero. Be careful. This is not financial advice, but wouldn't it be wonderful if it was? But it's not. Walk with the market, y'all. I hope y'all look at all three because I'm dropping jewels in all three of them. I hope y'all saw all three. If you didn't, if you skipped to this one, you better go back to part one and walk with the market and walk your way through the whole thing. I spend time with this every weekend. Stay in tune, stay in step, walk with the market. See you in the next video.